So we've been able to prepare a cash flow statement. Now we're going to look at how we analyze one. So first thing to realize is how it all looks together completed. So we have the operating section at the top, then we have to have the investing section, and then the financing section. So that has to be the order. We can't chop and change and move things up and down. Lastly, we'll end up with the closing section, which is the net increase in cash, cash at start and cash at end. And again, they need to be in that order. It's not acceptable if they're not. So what we want to look at is basically cash, your cash balance. It's basically a big tin or a big pot, and money comes in, and it can only come in from three places. It either comes in from running your business on a daily basis. That's called an operating activity. It either comes in from investing activities, which would be selling a non-current asset like property, vehicles or equipment, or it either comes in from the financing section, which is borrowings and capital contributions. So that's the pool of funds going into the tank. And what makes it go down? What decreases it? Well, there's only three sources again. Either money is spent on running your business on a daily basis, that's called operating, or it's spent on buying non-current assets, that's called investing, or it's spent on financing, which is loan repayments or drawings. They're the only three sources that money can be spent on. So looking at each section and whether a cash inflow, net cash inflow or net cash outflow is a good or a bad thing. From operating activities, if you had a net cash inflow, that's a great thing. That means you've been able to generate cash from your day-to-day operations, and that's how you should generate money. Your business should be self-sustainable from buying and selling stock and making more cash than it spends. And the good thing about that is you can use it to spend money on things like buying more non-current assets, which would be an investing activity, paying back any loans, which would be a financing, or paying yourself, which would be drawings. Looking at a net cash outflow from operating, is that a good or a bad thing? That's a very, very bad thing. And the reason is the business hasn't been able to generate cash from its day-to-day operations. So if the business can't generate cash from its day-to-day operations, where can it get it from? Well, the only other two sources left are these two. It's either going to have to generate money from investing activities or from its financing activities. And the reason why that's bad is if we sell non-current assets, or if we borrow money, or if we make a capital contribution, they're not sustainable sources of cash. We're not actually going to be able to use those assets ever again. They're gone. When borrowing money incurs interest, and the owner giving the business money, well, the owner doesn't have an unlimited source of money. You don't want to be constantly giving the business your own cash. If we had a net cash flow from the investing section, that could be a good or a bad thing. What it means is we've sold a whole bunch of non-current assets. So on one hand, that could be good. We could say it means we've sold some unproductive assets. For example, maybe we had 20 typewriters lying around that were just sitting there. No one uses typewriters anymore. We managed to sell them for a couple of $100s or something. That's good. We've sold some unproductive assets. Or maybe we sold an old computer and replaced it with a better computer. Well, that inflow is good, and that means we've got rid of an asset that's unproductive. Why is a cash inflow also bad in this sense? Because if we're selling off our non-current assets, we can't use them to generate future cash, and eventually we'll run out of assets to sell. Every time we sell a non-current asset, the good thing is we get money, but the bad thing is that asset's gone forever. If we had a net cash outflow from investing, that's actually a good thing. A net cash outflow, you think, oh, it's negative, it makes the bank balance go down, that's bad. Not necessarily for this section. Why? Because it means you spent your money on assets, non-current assets, that can be used to generate future revenues and cash. What about a net cash inflow from financing? That's very bad. The only two possible places that could have come from are from borrowing money from the bank or a capital contribution, and that's not good. They're not sustainable sources of finance. One, the firm has increased its debt, which incurs interest, and with the other, the owner giving the business money, that's not sustainable. Shouldn't go on forever. What about a net cash outflow from financing? We could argue that that's a good thing. That means you've either spent the money on one of two things: repaying loans or drawings to the owner. So why are they good? Well, that's good because repaying the bank means you reduce your debt and therefore you reduce your interest expenses. And paying the owner drawings is good. That's why you go into business. You go into business to make money, so drawings of cash are good. Ideally, this is how it should work. We should make enough money from our operating activities that we have so much of it we can use that to spend on investing and financing. So that's the ideal scenario. We don't have to generate any more money from investing or financing. So we don't have any money coming in through these two pipes if we don't need them, for example. What about spending money on operating? Of course, but we want most of our money coming in through the operating section. This is a bad situation. We've got money coming in through operating, let's say 100,000. Investing activities, actually 60,000 spent, and financing we spend 20. This is a good situation, sorry. This is where our operating activities have generated enough net cash to not only buy new assets of 60, but to also pay off debts and give the owner some drawings of $20,000. That's an ideal situation. This situation, we've got net cash inflows from operating of 100. That's great. On its own, that's fantastic. But we have gone and spent $130,000 on non-current assets. Now, we said that's a good thing because it means you've got assets for the future to generate cash. However, you've got to compare it to the operating figure. You look at that and go, well, we've spent more on non-current assets than we actually made from running our business. So where do we get the money from? How did we get $130,000 if we only made 100? Well, we must have borrowed some, or the owner gave the business money. So money must have come in through this third pipe of financing. So what we had to do was go and finance 40 grand from the bank in order to buy those non-current assets. That's not a good situation. This situation, we've got operating activities generating 100,000. We are financing activities negative 150, and on their own, that's good. 150 means we paid off a lot of bank debt and made a lot of drawings. But we've got to compare it to the operating. Again, it's not sustainable, that situation. Where is that money coming from to pay off your debts and take drawings? It's not coming from running your business. The only place that money could have come from was you must have gone and sold off some non-current assets, say $60,000 worth, and that's how you've managed to sustain your business with cash. Now that's not good because we said whenever you sell a non-current asset, it means you can't use it to generate revenue in the future. Situation 4, we actually spend money on operating, 50 grand. We make money from investing, like we sell a lot of non-current assets. So far it should be cause for alarm. We should never have a net cash outflow from operating. We've lost money from running our business. How do we pay the bills then? We must have paid the bills by selling a bunch of non-current assets. We got 30 grand from that, but that's still not enough. So there's only one other place the money could come from. If we can't generate enough money from operating activities to run our business on a daily basis, we can't generate enough from investing by selling non-current assets, it simply must have come from financing. We must have gone to the bank and borrowed 30 grand, or the owner gave the business 30 grand. That is not a good situation. That's not sustainable, and eventually we'll run out of cash.